Two titans stand at the forefront of digital finance, their names echoing across the globe, their influence shaping the very foundation of the crypto landscape. For years, Bitcoin and Ethereum have vied for dominance, each offering a unique vision, each rallying millions behind its technology and philosophy. Their battle isn't just about market capitalization or price action, it's about the future of money, the architecture of tomorrow's digital world, and the innovations that could redefine how we interact, transact, and create value. To understand this clash, we must first journey back to their origins. In 2009, amidst the fallout of a global financial crisis, an enigmatic figure known only as Satoshi Nakamoto released a white paper that would forever alter the course of monetary history. The idea was simple, yet revolutionary. A decentralized, peer-to-peer electronic cash system boasting transparency, security, and a fixed supply. Thus, Bitcoin was born, not just the first cryptocurrency, but a new paradigm, often hailed as digital gold. Its purpose was clear: serve as a hedge against inflation, a safe haven in turbulent times, and a store of value untethered from governments and central banks. 6 years later, another visionary, Vitalik Buterin, recognized the limitations of this original blueprint. What if blockchain could be more than a ledger? What if it could be programmable, dynamic, capable of executing complex agreements automatically? Ethereum emerged in 2015, transforming blockchain from a static record keeper into a vibrant ecosystem. With smart contracts at its core, Ethereum unlocked the doors to decentralized finance, NFTs, DAOs, and the burgeoning world of Web3. It wasn't just a currency, it was a platform, a canvas on which developers could paint the future of the internet itself. As the years progressed, Bitcoin cemented its status as the largest cryptocurrency by market capitalization, its brand synonymous with security and stability. Ethereum, meanwhile, became the engine of innovation, driving billions in value through its network utility. The race between these two giants is far from over, and as technology advances and institutional money pours in, the question looms ever larger: who will reign supreme? Let's first examine the strengths that have allowed Bitcoin to remain the undisputed leader for more than a decade. Its first-mover advantage cannot be overstated. Like the gold rush pioneers of old, Bitcoin blazed a trail where none existed, capturing the imagination and trust of early adopters, tech enthusiasts, and eventually, mainstream investors. It's the name people recognize, the benchmark against which all other cryptocurrencies are measured. This brand recognition translates into an unparalleled network effect, making Bitcoin the default choice for those entering the space. Security is another cornerstone of Bitcoin's dominance. The network's massive hash rate, the cumulative computing power protecting the blockchain, renders it virtually impervious to attack. Every transaction is recorded on a ledger distributed across thousands of nodes worldwide, making fraud or manipulation prohibitively expensive. This trust in the protocol is why Bitcoin is often chosen for large transactions and as a sovereign store of wealth. Perhaps most compelling is Bitcoin's fixed supply. Only 21 million BTC will ever exist, a limit embedded in its code and guaranteed by its decentralized nature. This engineered scarcity contrasts sharply with fiat currencies, which can be printed at will by central banks. As a result, Bitcoin is viewed as a hedge against inflation, a digital asset whose value is protected from the whims of monetary policy. The store of value narrative has taken root not just among retail investors, but within institutional circles. Hedge funds, corporations, and even nation-states have added Bitcoin to their treasuries, seeking refuge from economic uncertainty. It's no longer a fringe experiment, it's a recognized asset class, traded on major exchanges and offered through regulated financial products. Yet, Bitcoin is not without its drawbacks. Its design prioritizes security and decentralization at the expense of speed and scalability. The network can process only a handful of transactions per second, leading to congestion and higher fees during periods of heavy demand. Its scripting language is deliberately limited, restricting the types of applications that can be built on top. As a result, Bitcoin's primary use case remains as a store of value and medium of exchange rather than a platform for innovation. Now, let's turn to Ethereum, the engine of decentralized creativity. If Bitcoin is digital gold, Ethereum is digital oil, fueling an ever-expanding universe of applications and services. Its greatest strength lies in its support for smart contracts, self-executing agreements encoded directly onto the blockchain. These contracts power decentralized finance protocols, enabling lending, borrowing, trading, and earning yield without intermediaries. They underpin the NFT revolution, allowing artists and creators to monetize digital assets in ways previously unimaginable. They facilitate decentralized autonomous organizations, where communities can govern themselves transparently and democratically. Ethereum's commitment to constant improvement is another key advantage. The transition to Ethereum 2.0, a multi-year upgrade, heralds a new era of scalability, security, and energy efficiency. By shifting from proof of work to proof of stake, Ethereum dramatically reduces its environmental footprint, addressing one of the main criticisms leveled against blockchain technology. Sharding and other innovations promise to increase transaction throughput, lowering costs and improving user experience. A unique feature of Ethereum's economics is its deflationary mechanism. Following the introduction of EIP 1559, a portion of transaction fees is permanently burned, reducing the overall supply of ETH over time. This creates upward pressure on price, especially as demand for network activity grows. Unlike Bitcoin, whose supply is fixed, Ethereum's supply can actually decrease, making it potentially even scarcer in the long run. Developer adoption further solidifies Ethereum's position. Thousands of projects have been built on its network, ranging from stablecoins to decentralized exchanges, from gaming platforms to identity solutions. It's the blockchain of choice for innovation, attracting talent, capital, and community at an unprecedented scale. However, Ethereum faces its own set of challenges. During periods of peak demand, gas fees, the cost of executing transactions and contracts, can soar, making the network expensive for ordinary users. This has spurred competition from faster, lower-cost blockchains like Solana, Avalanche, and others, all vying to offer similar functionality with improved performance. Ethereum's transition to proof-of-stake is complex and ongoing, and while the potential benefits are immense, there are risks and uncertainties inherent in such a major upgrade. As the crypto ecosystem matures, the role of institutional investors, banks, hedge funds, asset managers, has become increasingly important. Wall Street's entry could be the deciding factor in the Bitcoin versus Ethereum debate. Bitcoin exchange-traded funds, ETFs, have already gained traction, offering regulated exposure to BTC for millions of traditional investors. These products validate Bitcoin's role as a legitimate asset class, increasing its accessibility and liquidity. But the spotlight is now shifting to Ethereum. The approval and launch of Ethereum ETFs would mark a watershed moment, allowing institutions to invest not just in a store of value, but in a technology platform with real-world utility. Ethereum's versatility, from powering decentralized finance to enabling enterprise solutions, makes it attractive for those seeking growth and innovation, not just safety and stability. If institutional capital flows into Ethereum at scale, the balance of power could shift dramatically. So, what does the future hold? There are several possible scenarios, each with profound implications for the crypto economy and beyond. In the first, Bitcoin remains king. Its status as the ultimate store of value, its unmatched security, and its fixed supply make it the default choice for those seeking safety and reliability. Governments and corporations continue to add Bitcoin to their reserves, and its price appreciates steadily as adoption grows. In the second scenario, Ethereum overtakes Bitcoin. As demand for smart contracts, decentralized finance, and Web3 services explodes, Ethereum's utility becomes its most valuable asset. Developers flock to the platform, innovation accelerates, and the deflationary mechanism drives scarcity. Institutions seeking yield and exposure to the next generation of technology pour capital into ETH, pushing it past Bitcoin in market cap and influence. The third scenario is one of coexistence. Bitcoin and Ethereum thrive side by side, each serving distinct yet complementary roles in the global economy. Bitcoin anchors the system as digital gold, a foundation of trust and value. Ethereum powers innovation, enabling applications and services that reshape industries from finance to art to governance. Together, they drive the evolution of money, technology, and society, ushering in an era where decentralization and transparency are the norm. As we stand at this crossroads, the significance of Bitcoin and Ethereum extends far beyond price charts and market rankings. They represent two visions for the future, a battle not just for supremacy, but for the soul of digital finance. Bitcoin's simplicity and security speak to those who seek stability and certainty. Ethereum's dynamism and adaptability appeal to those who believe in progress and change. But perhaps the real winner is not one or the other, but the transformative potential they unlock together. The rise of decentralized money and programmable trust has already begun to reshape how we save, invest, transact, and collaborate. Borders matter less, intermediaries become optional, and opportunities open up to anyone with an internet connection. The financial world is evolving, and these two networks are leading the charge. As you consider the future, ask yourself, what matters most? Security or innovation? Stability or adaptability? Is it better to build on a rock-solid foundation or to explore the frontiers of possibility? The answers will depend on your goals, your values, and your vision for what digital finance can become. Whether Bitcoin keeps its crown or Ethereum takes over, one thing is certain: the world of crypto will never be the same. The next decade promises even greater transformation as new technologies emerge, new challenges arise, and new opportunities beckon. The decisions made today will shape the landscape for generations to come. So, join the conversation. Reflect on the strengths and weaknesses of each platform, consider the impact of institutional adoption, and imagine the future scenarios that could unfold. Will Bitcoin remain the beacon of security and value? Will Ethereum's innovation drive it to new heights? Or will both thrive together, each playing a vital role in the decentralized economy? The journey is just beginning, and the possibilities are endless. Embrace the change, stay informed, and be a part of the revolution. The throne of crypto may yet be claimed, but the legacy of Bitcoin and Ethereum will endure, shaping the future of money and technology for all. What do you think? Will Bitcoin keep the crown, or will Ethereum take over? Share your thoughts, join the discussion, and continue exploring the fascinating world of crypto. The next chapter is waiting to be written, and you have the power to help shape it.